Hi everyone, you'll be preparing for the CMA final CFR exams, right? So in that, one of the important standard you'll learn in your specific accounting standards chapter is Ind AS 102 share-based payment. So if you look into the study material questions, they are proper questions with proper solutions by applying the provisions of Ind AS 102. But there are certain questions which are tricky that is coming in the examination. One of such question is the Amla, Jiloi and Tulasi Limited question that was asked in June 2023 examination. So let's try to decode this particular question. So before moving on to this concept, I'll just brush you through what are the concept with respect to a share-based payment in the Ind AS 102. So Ind AS 102 share-based payment divides the share-based payments into three buckets. One is equity settled share-based payment plan, second one is cash settled plan, and next one is equity settled with cash alternative. If it is an equity settled plan, they states that you need to check the equity settled share-based payment plans, the options fair value as at the grant date. The grant date fair value will be evaluated, and thereafter at each reporting date whether the service condition is satisfied and whether the performance condition, non-market related performance condition will be satisfied. Those kind of evaluations need to be made, and based on that you need to recognize the expense. So while recognizing the expenditure, you will be considering what is the fair value of option as at the grant date, and it will not be remeasured at subsequent dates. That is the concept with respect to equity settled plan. Whereas when it comes to cash settled plan, it is a liability. So they states that you will always remeasure the fair value of the SAR or the cash settled options. So and till it is settlement, we will remeasure it. That is the concept with respect to cash settled plan. And if it is an equity settled plan with cash alternative, there you'll divide the instrument into equity and cash settled, and we will follow differential treatment for that. So when we are seeing all those problems in the study material, that is perfect, that is fine, no issues will be there. Then it comes to this particular question wherein the institute had not given what is the fair value of option. So in that case, how to solve this particular problem, that is what we are going to learn now. So if you check this particular problem, they states that on 1/7/2019, Amla, Jiloi and Tulasi Limited, this company on 1/7/2019 granted 200 option each to their 2100 employees at rupees 120 when the market price is 400. So they had not given what is the fair value of option as at the grant date. They had given what is the grant date. They had given how much number of employees, what is the exercise price, what is the market price. If you consider this, the market price we are having is 400 and the exercise price we are having is 120, and this difference 280 is known as intrinsic value, and it is not the fair value of option. And they states that the vesting date for this transaction, this ESOP is 31st March 2022, and they are giving 1 year exercise period, and it will be exercised by 31st March 2023. So that is the concept they had given here. So if you consider this, we are having a grant date of 1/7/2019 and we are having a vesting date of 31st March 2022. That means from the grant date till vesting date, there are 33 months period in this particular problem. It is not 3 years. The grant date is 1/7/2019. So there is only 36 months as the vesting period. That is one important aspect we should remember about this particular problem. And thereafter they states that at the end of year 1, 100 employees had left, and thereafter they expects that the annual forfeiture rate is 10%. That is 10% of employees will leave thereafter for next 2 years. And thereafter they states that what is the fair value of share under ESOP as 128. So if you check at the end of first year, your intrinsic value is, the fair value of share is 186 and your exercise price is 120, and you are having a 66 rupees as your intrinsic value. And likewise, at the end of year 2, they are having 80 employees who had left, and they had re-estimated the expected annual forfeiture rate at 5%. So what is the remaining employees out of that? Again 5% leave in the next year. That is the expectation at the end of second year. At that date, the ESOP share has a fair value of 208. It is not option. Again, the share has a fair value of 208. So 208 minus 120, 88 is the intrinsic value at the end of second year. And the third year end, if you consider this, 192 is the actual number of employees left. So if you consider this, you were having 2100 employees, 100 left in first year, then 80 left in second year, and 192 left in third year. So this is the situation now, and it is vested at 1728 employees. That is the situation at the end of third year. And the ESOP has a value of 160. The share has a value of 160. That is, at the end of third year, your intrinsic value had got reduced to 40. So you don't have what is the fair value of these options. What you are having is intrinsic value at the end of each year. And they state that after the year end, 1700 employees had exercised this option by the end of exercise period. That means 28 employees had got the options, but they had not exercised, they got lapsed. And they states that the face value of each share is 100, and they state that as per Ind AS 102, calculate the expense to be recognized in year 1. This statement is confusing. It is not fair value method. They do not give any fair value. So that fair value, and what is the expense to be recognized in year 2, what is the expense to be recognized in year 3, and lastly, what is the value of options forfeited. So these are the question they had asked in this particular question. So before moving on to this answer, let me explain a provision which is to be applied when it comes to share-based payment. That provision will be applicable only in case of extremely rare scenarios. So I'll show the bare standard itself, wherein they states that if the fair value of equity instrument cannot be estimated reliably, what has to be done. So in the beginning of this video itself, I had mentioned that whenever we are valuing a share-based payment plan, that is an equity settled one, then we need to compute what is the fair value of equity instrument granted. The accounting will be made based on the fair value of instrument as at the grant date. So if that is available, we will not look into any other value. Since that is not given in the question, the fair value of equity instrument cannot be measured reliably. This situation we need to assume. Basically, in practical sense, this situation may not arise because the fair value of equity instruments can be measured reliably. Fair value of option can be measured reliably. There will not be any uncertainty if it is a quoted share. If it is an unquoted share also, the independent valuers will be able to find out the fair value of option. So this situation may not arise in normal scenario. But in rare cases, if the fair value of option cannot be measured, fair value of that instrument cannot be measured, in that case, the entity can use the provisions contained in paragraph 24 of the standard. They states that you need to measure the equity instrument at the intrinsic value initially at the date the entity obtains the goods or services, and subsequently at the end of each reporting period and at the date of final settlement, with any change in intrinsic value recognized in profit or loss. That is, if the fair value of option is not given in the question, grant date fair value of option is not given in the question, then we can assume that fair value of option cannot be measured reliably. In those circumstances, we need to compute what is the intrinsic value at the end of each year, and your accounting need to be done based on this intrinsic value at the end of each period. So that is how this problem need to be solved. So let's solve this particular problem. Let's pull out the figures and let's solve this particular problem. So it is your question number 4A in your June 2023 examination. So let's write answer to this question. So here, when it comes to this particular problem, we need to start with the type of share-based payment plan. So the type of share-based payment plan we are having is the equity settled plan. So we need to identify what is its nature. And the step 2 we are having is what is the grant date. In this case, the grant date we are having is it is 1/7/2019. So this is your grant date. As step 3, what we will be doing is that we'll see what is the type of vesting condition. If you consider the type of vesting condition here, it is a service condition wherein no performance target is given. So it is just a service condition, and the vesting period we are having is nothing but it is from 1/7/2019 to 31/3/2022. So basically this period covers 33 months period. So that is the case with respect to your vesting period. And now when you consider this here in this step 4, usually we will compute what is the grant date fair value of option. The grant date fair value of option in this question is not available. So in that case, what we need to do is that it is assumed that the fair value of option is not measurable as at grant date. Therefore, what we need to do is that the accounting will be based on intrinsic value method as specified in para 24 of Ind AS 102. So that is what we will be doing in this particular problem. So for that purpose, let's prepare a particular table which consists of how to compute the value, that is expense to be recognized in each date. So let's take a statement showing recognition of expense in each date, in each year. So in that I'll be taking year, and there will be a number of employees column, and the intrinsic value that is not directly given, so we need to compute that. So for that, one column needs to be there, and you need to have a cumulative expense column, and you need to have an expense already recognized column, and an expense for the year column. These are the columns required in this problem. So let's do this problem based on this. So here let's start our problem. So the first year we are having is 2019-20. So in this 19-20 financial year, what is the number of employees which is expected to vest is 2100 was the number of employees. Out of that, 100 had left during this year. That is what given in the question. So if you see this particular question, 100 employees had left in the first year. So remaining 2000 employees are there. Out of that, 10% is expected to leave at the end of each year. So first year 10% leave, so balance 90% will be there. And in the after second year, third year also another 10% will leave. So the number of employees expected to vest is 1620 only. So that is your number of employees expected to vest. So the 1620 employees, that is what is expected to vest at the end of first year, at the end of 1920. So how we had arrived is, what is the number of employees left, that is reduced from the total number of employees. Then we had reduced what is the annual annual forfeiture, that is 10% we had reduced for the next 2 years. So we had arrived at 1620. And when we compute the intrinsic value, we had already computed that at the end of first year, the fair value of share is 186. We need to take this 186 out of, from that, we need to reduce how much is the exercise price. The exercise price is 120, that needs to be reduced here. So the result 66 is the amount you are having as your intrinsic value. So you can take this. So how much is the expense we need to recognize? So we are having 1620 employees. Each employee is entitled for how much? 200 options. So this 1620 into 200 options into, we are having rupees 66 per option into, your grant date is 1st of July till 31/3/2020, that is year end. There are 9 months out of 33 months vesting period. So if you consider what is the expenditure, 58 lakh 32,000 will be the expense that has to be recognized by the end of first year. And no expense was recognized for this in the prior years. So 58 lakh 32,000 is the expense for this particular year. So that is the answer for the first one. So they had allotted 4 marks for this portion. And when it comes to 2020-21 as well, the number of employees we are having is 2,100 employees were there. Out of that, 100 had left in the first year, and in the second year 80 employees had left. So that 80 is also to be reduced. From that, in third year we are expecting a 5% reduction. That means our balance 95% will vest. So you'll be having number of employees expected to vest as 1824. So that 1824 is the number of employees expected to vest. And if you check the intrinsic value, the fair value of share at the end of second year is 208. So 208 minus 120, you are having how much rupees? 88 rupees as the intrinsic value at the end of second year. So when we are following intrinsic value, you will be considering the change in intrinsic value at the end of each year. If it is fair value of option, under equity method, we will not remeasure subsequently. But if it is an intrinsic value, we will remeasure that value as well. That's the reason why we are taking fresh intrinsic value each year. So 1824 employees will be there. From there, 200 options is there for each employees. Rupees 88 is the intrinsic value. And if you consider this from 1/7/2019 to 31/3/2021, in the first year there are 9 months, and in the second year 12 months, total 21 months elapsed out of 33 months vesting period. So we are having a cumulative expense to be recognized as 2 crore. The cumulative expense that has to be recognized is 2,04,28,800. From that, 58,32,000 had recognized in the last year. So the balance amount will be recognized in the current year. That is, if you consider this 2,04,28,800 minus 58,32,000, okay, you'll be recognizing 1,45,96,800 as your expenditure in the second year. So this is how you need to recognize this figure in the second year. In third year, it is simple. 21-22, what happens is 2,100 employees were there. From there, 100 left in the first year, 80 left in the second year, and 192 left in the third year. So it is actually vested on 1728 employees. It is actually vested on 1728 employees. And on that date, your fair value of one share, they had given us 160. So that 160 minus 120, you are having 40 as the fair value of, or intrinsic value of this option. So the expense to be recognized is 1728 into 1728 employees into 200 options per employee into 40 is the fair value we are having into 33 months elapsed out of 33 months. Entire vesting period is elapsed. So we have to recognize only 1 crore 38 lakh 24,000 till now. But we had recognized an expenditure of 2 crore 4 lakh 28,800 cumulatively over last 2 years. So from this 1 crore 38 lakh 24,000, we need to reduce 2 crore 4 lakh 28,800, and there will be a reversal of expenditure of 66 lakh 4,800. And the number of options forfeited, okay, value of options forfeited, that is the last requirement we are having. So out of this 1728 employees on which these options had vested, they had only exercised, the employees are exercised to the extent of 1700 only. Only 1700 employees had exercised this option. 28 employees had not exercised the option. So 28 into 200 per employee into 40, rupees 2,24,000 worth options were got forfeited. This is the final answer we are having with respect to this particular problem. So basically, when we are solving this particular problem, the concept we are using is, usually when it comes to equity settled plan, we are required to compute what is the fair value of option as at the grant date, and that value has to be considered throughout the period for the accounting for equity settled share based payment plan. However, if the fair value of option is not available, you need to compute what is the intrinsic value at the end of each year, and based on that, just like an equity cash settled plan, you need to compute the intrinsic value, and based on that intrinsic value, each year accounting needs to be made. That is what is to be done when it comes to a share based payment problem like this. So this is what we need to discuss about this particular problem. Let's do some question paper analysis in the upcoming videos also. Stay tuned. All the very best. Thank you.